Hi everyone, sorry for the late start. I just a little bit of difficulty with the sound and the internet. If you can hear me okay, could you just type yes into the question box and we'll get ourselves underway. Fabulous, thank you so much. All right, sorry that was my fault. Little internet issue. Very good. All right, so welcome to week 3. We're going to talk about indicators tonight. A couple of indicators. As you know, there's more than 150 different types of indicators available. We're going to go through some of the common ones and have a look at just some tips and tricks about how they work and what you really need to really focus on understanding about them. So again, welcome to week 3. I need to just read this. The information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. So you must consult a licensed advisor before acting on any information you see or hear. For those that haven't been here before, I just go through my background again. I hold the diploma in analysis through FinCEA, which was obtained back in 2003. I'm a certified analyst with the IFTA, which is the International Federation. And in the past, I held derivatives accreditation 1 and 2, ADA 1 and 2. I spent 7 years plus on the broking desks of Macquarie and RBS Morgan's, Wilson's, HGM. So currently my life revolves around being a member of the Professional Technical Analysts Association of Australia. I write for Thomson Reuters once a week. I write for First Prudential. You'll see the black and white report up on the website. It's there every Monday morning for free. And I contribute to the Trading Edge magazine in the commodities corner, and I currently trade my own account. As always, I mentioned, if you're setting up your trading as a business, more than just a hobby, or even a good hobby, keep your desk tidy, get all the stuff off your desk except what you need to conduct your trading, and so you can focus on what you're seeing on your screens and giving thought to the markets rather than everything that's stacked around you. So clean up your desk, tidy up the area around you, and keep it nice and clear of any other sort of distractions along the way. And I've always said that you don't need state-of-the-art hardware. You only need reliable hardware, and there's plenty of that around these days, and reliable software. And you need a backup plan, which means you need a second internet connection in case one goes down, which happened to me on the way in tonight. So successful trading is not about how much money you make or how much you make. It's really about how much you don't lose. I mentioned this in week 1 and week 2. It is not about looking for that, it's not about hanging on for that home run trade every time. It's really about money management is the secret to trading, and you'll find that your stop losses are the secret to trading. And there's some statistics around that fly in the face of what people would regard as their first approach to trading, and one of them is a breakout trade. And a breakout trade, Bulkowski did a little bit of work on this, and this is very generalization, but basically a breakout trade, something that trades above the last 20 days or something that trades below the last 20 days in a bear market, that type of thing. Your best returns are found within the first 7 to 14 days. Those breakout trades after 70 days, often they're about 1% chance that it'll still be running for you, because markets move up and markets move down. And this idea of breakout trading needs a little bit of back testing before we call that a valid trading system, and we'll be going into that next week. But this week, the intention of this is so you can build a foundation on the correct application of technical analysis. Week 1 and week 2 are available on the FP Markets YouTube channel. If you haven't been here for week 1 and 2, I would encourage you to go back and have a look at those weeks. And we really want to encourage you to discover your own trading plan, not my trading plan, or the person next to you's trading plan, but your own trading plan, and understand the risk and account management, which we'll be going into next week and the week after. So when people talk about technical analysis, I'm being a bit repetitive about this because it is so important. The technical analysis comes around this idea of looking for consistent analysis of past data. So when people say, well, you know, the future's going to be the same as the past, or it rhymes or whatever, yes and no, but we're looking for a consistent analysis of past data to help us build a bit of a picture about what's going on right now. And then we can build some rules around that, these similar and recurring events. And then we can identify entry and exit conditions out of that. That's our technical analysis, understanding trend, understanding basic price patterns, understanding today, looking at a couple of indicators, that type of thing. But a lot of people think that the better they become at technical analysis, the better trader they will become. That's somewhat true and somewhat not true. Basic trading, when you look at the art of trading, if you like, trading is about keeping basic records. It's about controlling your risk in the market, understanding what can go wrong. It's about the money management of your account, your position sizing, which comes back to your risk, and is brokerage a factor in your trading or not. Then there's the psychology of profit and loss. And a lot of people today, particularly in the Australian market, are dealing with a bit of psychology around profit because there are a number of stocks today were up 10 and 12% for the day, which is something you would normally see in a year. So there's an interesting where I see a lot of people leave too much money on the table for fear of handing it back at some point in the future without any real understanding of their basic chart analysis. So this week we're looking at indicators. Week one was based around trend, and week two price action. This week indicators, and next week we'll be looking at building a trading plan around that. So we'll be so as I mentioned, week one was about defining the trend. Just as a reminder that primary trends are only observed on the weekly chart. You cannot find a primary trend on a daily chart. You are truly wasting your time trying to build an analysis picture on your daily charts. Step back, and if you're involved with trading and finding trading quite stressful, just step back a little bit, take a deep breath, and have a look at whatever you're doing on weekly charts and find out where the observable trending action is. And using price only, and this requires a large time frame chart. So you just take a big picture look at where something is really going. And then we understand that then trends are developed on trending action. Consolidations are the second, what we call the secondary movement, and then there's a corrective actions in the chart. So a trend, a primary trend, is always observed with the market on a weekly chart up here. Market makes a low, market makes a high, and market makes a pullback. And then as price moves past the previous significant high, you have a primary trend in place. I keep referring to next week, but next week I'll be using a lot of line charts, and I'll show you a really clear way to see that again. But essentially, when price moves past a previous high after a significant retracement, and when significant retracement referred to about 10%, at least 10% pullback of the price value, then we're looking for this movement again. This is out on the weekly chart. If it breaks a previous high, we have a primary trend in place. We're then looking for that trend to continue. Hopefully that trend will continue with a series of higher highs and higher lows and higher highs. And then there are times when trends don't continue and there'll be a lower high in front. And as we break the previous higher low, as we move past this previous higher low, this area just here, as price moves down past that, you'll see that the market then is declared in a primary downtrend. So I'm going to upset a few people here. Gold is in a primary downtrend in a weekly chart. Just look at this simple little pattern and you'll find it in the gold chart. All right. So then often that trend continues. If you want to take a good look at that, AGL at the moment is in a significant primary downtrend. So when we look inside trends, if we're looking inside a piece of price action, as it unfolds and gets higher and higher in this case, these secondary reactions, these clusters of price in here, these retracements and the clusters of price in here, and can often lead to trading errors based on different time frames. So what that means is that in here we have a weekly uptrend, a series of higher highs and higher lows. And along the way, there are consolidation periods here, and certainly up the top here is consolidating again. When you look inside these consolidations in a different time frame, in this case a daily time frame, you'll often see a trend. Lower high, lower low, lower high, lower low, lower high, lower low. So, sorry, higher low. So it defines a trending action. Traders will often look at this and go, well, it's trending down, unawares that it's actually just part of a significant primary move going the opposite direction. So we have situations where in two timeframes, trends can be going in opposite directions to each other, and our business as traders is to find the ones where the two timeframes match up and allow us to take a position. So this is AGL Energy I mentioned a little earlier. This was from last week. This has actually turned down again this week as part of the trending action. It's actually moved a little lower as well. In week 2, we started to define price action, and we looked at what constitutes a pivot point. And this applies to all time frames, from 5 minutes out to weeklies and monthly charts. So a pivot point is defined, and this is I would really encourage you, what we encourage you to do all through this series is build some solid basics around what you observe in the charts. It either is or it isn't, and we can do that with pivot points by saying, is there a spike low? And we mentioned that a spike low has a higher low either side of it. Just a bar with a higher low. We don't know it is a spike low until the third bar is complete, but essentially a spike low is a bar with a higher low either side. So then we're looking for a close over the high of the low bar. So this becomes the low bar here, and we want a closing price over that high just here. Constitutes a pivot point. It's rigid, can't be, there's no argument about it, and that's what we want when we start to build our trading plan or our trading rules. And then we said that a pivot can form within, we'll give it 3 bars. A pivot can form within 3 bars. So shows as a spike low, so that's our low with the higher low either side, defines our spike low. And 1 bar, 2 bars, 3 bars, if we get a close over this high, it can be defined as a pivot point. If it goes out to 4, 5, and 6 bars without a close over there, then it's something else going on. And a reverse pivot, bearish pivot, is the same. We end up with a spike high. Spike high is the price makes a high and has a lower high either side, and we don't know it is until the third bar is complete. And the pivot is determined as price closes below the low of the bar that makes the high. It's a strict fixed rule. And then we can go and say, well, the pivot can also occur within 3 bars. So spike high, 1 bar, 2 bars, 3 bars, and we get the closing price below the low of the bar that actually made the high. So pivot point is determined with these actions. Then we looked at a thing called a 3-bar reversal, and a 3-bar reversal very similar to a pivot point in place, but we can take the third bar as being inside the last 2 bars. So it must be inside the last 2 bars, must have a higher low than the low of the bar that makes the low, and must have a lower high of the second last bar in the retracement. So it becomes what's called a 3-bar reversal. And then we introduced another rule around this and said, well, we'll take notice of the ones where the low here is at least the lowest low in 8 bars. That constitutes a fixed rule, so 8 bars or more, and we see this type of pattern, we'll refer to it as a 3-bar reversal. So let's take a look at indicators here. We'll get ourselves underway with this. And the last thing you want is indicators behave like sycophants or sycophants, flattering you by confirming your opinion, telling you what you already know, or worse, what you wish to hear. The time that this trap most often bites is when a user looks through a number of indicators until one is found that confirms the analysis. It's often when you're in a losing trade, often when you've got your back to the wall, often when the markets aren't doing as we anticipated, we start to look through indicators to confirm while we still should be holding a position. Or if we're looking to enter into a position, we will look through a number of indicators to confirm while we should also be entering that position. So a sycophant, of course, is a servile self-seeker who attempts to win favour by flattering influential people. You being the influential person, and the indicator will often try and flatter you with that information, or we'll see what we want to see inside that information. So we need to then understand what we are looking for in that indicator. So we're going to take a look at some averages, some oscillators that look at the volatility indicator and volume as we go. So we're going to leave a bit of room at the end of this presentation for some questions, and we'll get ourselves underway. So moving averages, there are three basic types of moving average. The simple moving average, SMA, the exponential moving average, EMA, or weighted moving average, WMA. And on a chart here, this is Newcrest Mining. It was taken a couple of days ago when I was putting this presentation together. It is a daily chart. Let me get my pen. There we go. So it is a daily chart up here. We can see that the daily trend is putting in a low, putting in a lower high, putting in a lower low, putting in a lower high and a lower low. The daily trend on Newcrest is down, and I think if you look in the weekly, it is also down as well. But what I've got on here are three types of moving average. One is the simple moving average, which is the blue line, the exponential moving average, which is the magenta line, and the weighted moving average is the green line, and they're all at the same settings. So what they do is they react differently to the price. So an exponential moving average is a type of moving average that gives greater weight and significance to the most recent data points. So these most recent data points in here become the where the exponential average takes most of its calculation from, whereas a simple moving average will simply average out the last, in this case, the last 10 periods and come up with an average value. Exponential moving average just gives greater weight to the front of the front data inside that look back period, in this case, 10 periods. And then there is the, oops, let me go the other way, sorry. Sorry, then the weighted moving average, I should say, that's the one I missed. The weighted moving average is a type of moving average that again puts more weight on the recent data and less on the past data. So weighted moving average, the green one here, we can see is the follows the price action a little closer in its calculation. And the exponential average is the one that's really starting to move along. I took this snapshot again today, just this afternoon, and we can see that Newcrest has rolled and put in a reverse pivot. So we've got a little pivot bar here today, set up today. The close here is lower than the low of the bar. This is the spike high just here. Excuse my mouse writing. So that's our spike high. We've now got a reverse pivot in line with this trend up here. This is an interesting, the reason I have this here is I noticed on a couple of social media sites that a lot of people are looking into buying Newcrest. They're essentially buying, which is fine, so long as they admit that they're buying the they're buying the downtrend, the daily downtrend, and if they're comfortable with that, that's fine. It doesn't suit my trading plan, but it's comfortable with that, that is fine. So let's take a look at oscillators. So let me go back. I'll go back one point here. The moving averages, if we place a moving average on a chart, essentially we can see here that these moving averages are essentially supporting the price action, and I've got a 10-period average in here. And we can see as we go along that essentially they support the price action as support or resistance in there. So there's a breakthrough there, then resistance here, and so on. So it really depends on what average you put on there, and to create I could put a 2-period average on there and it would create a buy signal. If we put a 200 simple moving average on there, I know for a fact that the 200 average is way above, it's well below, price is well below the 200-period moving average, so that doesn't suit at all. So often we'll change things around. Now let's take a look at oscillators. So oscillators are tools, if you like, that oscillate between a 0 value or a 100 value. There are other oscillators that work around a 0 line, and they're a little bit open-ended on their limits. So there's two types of boundaries, if you like. One is bound around a 0, and the other is bound between a 0 and a 100. When we look at oscillators, some are based on average price and some are based on momentum or price movement over a period of time. So when we look at the MACD or the stochastic, it's really based around average price. And then we start to look at price oscillators, and we go across then to relative strength, which comes in under as a momentum indicator. When you're looking at your indicators, understand whether they are based on a price movement or whether they are based on momentum, which is a calculation of price over time. We look at the MACD. The other key aspect of indicators when you bring an indicator onto a chart is use the author's settings that they spent years developing in some cases, and they really have put a lot of statistical work into what are the best settings. Start off with their settings first, understand what they want you to see, and go from there. So when you're looking at a MACD, MACD is 12, 26, and 9. MACD is based around an exponential moving average. So just keep in mind the MACD is a momentum indicator, and it's only useful during trending phases. MACD works best in a rising or declining channel. Now what that means is as price starts to swing, we really want our MACD also to swing as well. To confirm what we're seeing, what's happening in our chart, looking at these momentum moves. So MACD, this is the S&P ASX 200 or the XJO. They're down the bottom here. I've displayed the MACD. This is a weekly chart showing up here. This shows the corrective move that we had during February this year. And since then, the market has entered back into a primary uptrend. We have a low in here. We have a high in here. We had a pullback into here. So our market now has entered into a primary uptrend. And we've got getting a little bit of consolidation. So we had a secondary market through here in this pullback into the low. And since then, we have moved back into primary trend. The MACD gave an early signal, an early buy signal down through here. Buy signals on the MACD, and you can see that the values here, minus 200, minus 400, are quite deep. But it gave an early buy signal, but however, there was no evidence in here as to whether we should be buying a trend or not. So just keep in mind that the signal line, which is the red line, is a combination of the 12 and 26 exponential moving averages, and the blue line here is a 9 exponential moving average over the top of that. If you're looking, depends which charting package you're using, just be aware that for some inane reasons, some charting packages will use a MACD on a simple moving average. So here is the same piece of price action. MACD showing as an exponential moving average, MACD showing as a simple moving average. This is clearly wrong. MACDs are based around exponential moving averages. They're there to catch momentum swings, is what they're looking at. So just check in your settings on that, whether you've got the right settings on your MACD. The clearest or the best use, if you like, of these types of indicators, they often give multiple signals. For example, if you're looking for a MACD crossover, it's giving you a buy signal here, even though the price is still moving down, and this is a weekly chart up here. So price is still trending down on this weekly chart, but it's given you an early buy signal, and then a sell signal in there, then another buy signal. What's really quite good about when you're looking to find bases in price action, and this is Bega Cheese, I think, when you're looking to find bases in price action, and here we have Bega Cheese basically over 2019 and 2020 has put in this huge base in here and has now started to trend up. This is a weekly chart, as I mentioned. So we have now the lows in here, we have the high in here, we have the higher low in here, the higher high. So this stock is trending, and the higher low in here, and just a couple of days ago, it went to a higher high. Okay, so we're into a primary uptrend. Prior to the trend, changing from a downtrend into an uptrend, we saw divergence in the MACD. And divergence is based around the closing price. Now, a lot of people think that divergence is based on the shadow or the wick of the candle. Nothing could be further from the truth. It is simply because these are calculated on closing prices. So we use the closing price as our observation for divergence. So our closing price low here, our closing price low here, our closing price low here. 1, 2, 3 lows getting lower, but we can see that our MACD is actually moving higher in here. Essentially, the price is slowing down in its movements on the way down through here, and MACD is catching up with it. The averages are catching up with it, and we often see these very slow swings back into primary uptrends. So it's out here that we should be looking as our long trade, and certainly anything this type of signal will give you a signal, particularly if you short the market, will give you a signal that this has potential ending coming in here. This divergence indicator is an extremely good tool for in the larger time frames. So I'll show you some of the work that I do next week based around this. It is incredibly reliable observation of price action. We're not here to buy the low tick and sell at the high tick. We're here to create high probability outcomes from our observation of price action. So bullish divergence occurs below the zero. So if you look at the zero line, we can see this bullish divergence signal must occur below the zero line as the MACD swings higher and price swings lower. So bearish divergence, this is in elders at the moment, again, weekly chart. We're starting to see elders put in a lower high just here and a lower low this last week. Was off a little today, but on the way up as this price got higher and higher, the closing price here, and closing price here, we could see that the series of high closes and the MACD itself, the signal line, was getting lower or flattening out in here. Not really following the price upwards, it is simply flattening out and giving a divergence to our price underway. One way to use this as a secondary confirmation, this MACD, and we can see down here it is given a number of buy signals down here without any evidence of trend underway. But once we start to see buy signals with evidence of trend, as this starts to trend, then we have potential to put a fairly solid observation together around our price action. MACD, this is the Dow 30, and I've taken this off MT4. MT4 displays the MACD a little differently. The orange here is essentially the crossover line, like that. But it's if you run a 15 period exponential moving average, you'll see it because the MACD is essentially the signal line is a combination of 12 and 26 exponential averages. It's the average of those two lines. If you run a 15 EMA on here, as we see the signal line cross over here, we often see price also cross the 15 EMA. This can be easily back tested for those that are code savvy. And here on the weekly chart, this is on the daily chart, and here on the weekly chart, we can see as the signal line cross through here, we start to see our price start to move above a 15 EMA. So it's an interesting combination of the two on there, just to give a little confirmation, potentially a little early confirmation. This is a weekly chart in here and a daily chart on the left-hand side. So it's same two EMA, so 15-week EMA, 15-day EMA on there, and they can give very, very similar signals. And again, this is the Australian US dollar. As the MACD swung up through here, as we crossed our signal line, it also crossed a 15 EMA on there. Just be aware at the moment, I know the Australian dollar's gone to 74 cents, but there is also now a divergence signal inside the Australian dollar based around the weekly chart. So it's interesting. We would be looking for potential some sort of reversal here based around this early divergence here. This is certainly not the place to get too long on something without another buy signal coming in and this pushing into a new high in there to confirm the MACD itself. But again, as the signal line crossed over here and we saw it cross the 15 EMA on there, the two of them together offer some insight into potential price movement. And this can easily be back tested, and I would encourage you to do that. All right, let's go along. Commodity Channel Index, another useful tool. This is a reversion tool, a mean reversion tool. So Commodity Channel Index, this is a Bitcoin at the moment. It has a 20 period, Commodity Channel Index is based around a 20 period moving average, simple moving average. And we can see the daily chart here is running above the 20 period average on here. So what the Commodity Channel Index does quite simply is takes that average, that 20 period average, and stretches it out into a flat line, and then measures the closing price distance, the average closing price of the last 20 days as its distance away from the center, the 20 period moving average. So as it becomes extended, as the price crosses the 20 period average, so we see the signal line cross the zero line on there. So it can give you an idea that prices are extended, or they're simply, in this case, the 20 period average is catching up to price, and the two are, if you believe in reversion to the mean, that's what we got down here. And the 20 period average focus, it shows up in a lot of indicators. The other one, of course, is Bollinger Bands, but a 20 period average is considered to be a fairly useful tool. Here, Bitcoin on the weekly chart again, as it crosses the zero line here, as extended itself away, is expected to revert back to the mean, and that's what occurred through here. And we saw it trade above the 20 period average out to where it is at the moment. So at the moment here, we could call this extended away from the average. So we'd be looking for either reversal or consolidation to catch up with the price itself. Momentum, this is one of the better tools I have found in any trading strategy that you build this relative strength momentum tool is probably one of the better tools around. One of the key aspects of, as I mentioned earlier, is divergence, whether it's in the MACD or in the relative strength. And divergence, bullish divergence, consists of a price making a low, price is moving down, makes a low, makes a retracement. The indicator itself moves down below 30, the RSI moves below 30, and then rallies above 30 as normal part of our price movement action. And then we see the price make a lower low, so it's still trending down, but the RSI makes a higher low, so it's moved down here on a combination of less points lost on the way, average points lost on the way down. I'll go through that in just a moment. But a swing buy signal occurs when the RSI simply moves back, and this must be below 50, I should mention, when the RSI moves back above that internal high there and creates what we call a swing buy signal. So this divergence signal is an early sign that we've got potential trend reversal underway as momentum slows, as the downside momentum slows. So it's, again, I stress to you that it is based on the closing price. It is not based on the range of the bar. These indicators are calculated on the closing price, so we have to look at the closing price for that type of divergence. Here we can see closing price here, and 2 bars later we can see a lower closing price, but our relative strength has made a higher low, so our divergent buy signal occurs inside here. Now this can't be the reason to buy something unless you're on the top of your game, which most people are, I agree. If you understand your risk and understand what's going on, they can generate buy signals, but I tend to look at this as something I need in the background to confirm, or one of the things hopefully in the background, to confirm that there's at least a new trend underway, possibly a new trend underway is what I'm looking for, this in the background to confirm that. So bullish divergence is where the market makes a new low against the relative strength, or the RSI making a higher low, and all the while below the 50 level in there. So bearish divergence, of course, is where the market makes a high and goes on to make a new high, but the indicator itself makes a lower high. So the RSI swings above 70, and I'm going to ruffle a couple of feathers here. When the RSI swings above 70, everyone says it's overbought. That is not true. It just means that there is incredibly strong momentum. I've seen the RSI remain over 70 for months in some stocks. It is just simply says that it has very, very strong momentum. However, as it comes down and remains above the 50 here, and then swings in to make a lower high as the price makes a higher high, it then look for a swing sell signal just in here. But we need a little evidence in our price as well. But the signal in the background is highly useful for looking at potential tops in markets, in equities and commodities and FX as well. In Bitcoin at the moment, on the daily chart of Bitcoin, there is bearish divergence. We've had and this is going back to early November on this particular chart back here. And we can see the RSI is above 70 all the way up to the end of November. A dip below the 70 line, remained above the 50, and is now hovering around the 70 line again as the market pushes a little higher. So we have a bearish divergence signal coming up, currently showing in Bitcoin on the daily chart up here. On the weekly chart, also on the weekly chart of Bitcoin, we're seeing early stages, a little too early to tell yet, but we can see that the market has made a high here as the indicators made a high. Didn't cross below the 70, so it quite negates this a little bit, but I would point out that currently the relative strength is showing slowing momentum on this push, this current push up here this week. This was taken just a couple of days ago. So the relative strength, this is worth looking into. It's essentially the average of the upward price change against the average of the downward price change. And in a worked example here, this is, if we look at a RSI, and it's always used as a 14 period RSI. I'll work through this sample here, and we look at the market here. This is the S&P 500, and we can see on this day here it was 3,145 points. 14 days later it was 3,240 points up here. So essentially a gain of 95 points on the way or so. If we look at how it got there, with the up days and the down days and the up days and the down days, if we add up all of each points gained from the previous period, we add them all up, we come up with 98 points gained. If we divide that by 14, we get our average of 12.3 points gained. If we look at the retracements, the down days where it actually lost points, if we add up all of those, there were 16 points lost on the way, which is a total of 2.6. So the market's gone from 3145 to 3240. The RSI has gone from 63.98 to 78.43. All good. Except up here, the market went on to move into 3,329, basically another 80 points or so from the lows. If we look at if we add up all of the gains on there, a total of 154 points gained over the 14 periods, and then the total downside was 65 points. Now here we had a downside of 16, here we have downside of 65 points, an average of 13 on there against an average of 2.6. So we're starting to see that the market is higher, but it's doing it harder getting up there. The pullbacks are getting larger. We can see in here we had 10, 3.5, half a point, 1.5 points. Here we're getting 19, 23, 9, and 5. These retracements up here. So it's then the RSI went on to measure 76.56. So we're starting to see divergence come in as the market goes higher. We're starting to see the RSI go lower. All right. One of the key aspects of using RSI as a trading tool is just simply looking for a 50, looking for it across the 50 mark. So here is the 50, the middle of the range. RSI revolves essentially around 50 down to 0 and basically 0 and 100, but the 50 is the key middle area there. This is a weekly chart. Often when you see the RSI cross the 50 line, we often see the beginnings of new momentum moves. This is essentially, as this moves up here, momentum is increasing to the positive side, and then we get the decrease, of course, as prices consolidate, momentum slows down, and as it swings back across the 50 line again, we often see these movements get underway again. And another one just in here, and we saw this movement get underway here. So this is gold. You know, on a weekly chart again, when you stand back and look at your observations of the market in these larger timeframes, find out what this is doing, whatever it is you're looking at doing, find out what it's doing in a larger time frame. Come down into your time frame that you want to use. If you're getting a buy signal here in a larger time frame, drill down into your time frame and see if you can find the same buy signal that would correlate between the two. So currently gold is just trying to cross the 50 line again. This was taken just a couple of days ago, I think yesterday, and the RSI is just trying to swing across the line again. There's no divergence in here per se. We've had the high on the RSI, the high in the market. As the market's consolidated down, and this is the low, this is the lower high, gold is in a primary downtrend in there. If you buy gold down here, you are buying a downtrend. I don't have a problem with that, just as long as you say to yourself, I'm buying a downtrend. And RSI is just about to cross 50. I think waiting for evidence to suggest that there's an uptrend will certainly stack probability on your side. Here on West Texas, again, as this when we look at the weekly chart on West Texas, just recently the RSI made a number of crosses over the 50, but the last one here also created a pivot point. So this bar here closed above the high of the bar that made the low. So on that week, we had a pivot point in place. We had the RSI swing over 50 with a technical pivot point in place. In the daily chart, this was the Monday open, Monday, Tuesday, Wednesday, Thursday, Friday. This was the confirmation of the pivot this day here. Monday created its own pivot point as well, but Friday confirmed this is where the week closed. The week closed up here. And we have the RSI also ranging over the 50 level. That's our 50 level. RSI over 50, weekly RSI crosses 50 on here, and you have a technical setup in the weekly chart, a technical setup in the daily chart. There's only one direction to take on the trade. Bollinger Bands, volatility. When we look at volatility in the market, there's a couple of Bollinger Bands give a lot of interesting information. Some of the better information is around, again, looking at how volatility works in trends. So when you look at a Bollinger Band, the upper band here and the lower band is centered around a 20 period simple moving average. And the price is the average deviation of 20 closes times 2. So it looks back in the last 20 periods against the 20 period average, looks at the distance the closing price is away from the average, multiplies it by 2, and plots the value of the Bollinger Band here. John Bollinger's done a huge amount of work on this. Don't change the settings. The settings are 2 standard deviations and a 20 period simple moving average in the center. Bollinger Bands are very, very useful in looking at what we call relative deviation. So down on the left-hand side here, a bit of a squeeze on the bands here, that was interesting, but we saw the price break into new lows here and start closing outside of the Bollinger Band. So volatility was becoming outside of the 2 standard deviations, and as price moved down here, we then saw a rally. And I'll just draw across the top of this, sorry. We then saw a rally in price. We then saw a higher low come in, and that low was inside the Bollinger Band, inside the lower Bollinger Band. This concept here where price closes outside of the Bollinger Band, swings high, in this case found resistance at the 20 period average, and then makes a higher low inside the Bollinger Band is incredibly high. Incredibly good observation that we're about to see a trend change. Downside volatility has eased and we're starting to see trend change. So this was on Bitcoin as well. Prior to the run up, we saw up at 19,000 currently. Again, as the market swings outside of the Bollinger Band and then makes a lower high inside the Bollinger Band, is confirmed by pivot, we saw the market move lower and outside the Bollinger Band. This one failed. There was a higher low inside the band, made a new high for a short while, and then simply failed back into around the 20 period average at that point in time. So it's not a foolproof tool, but it has a high outcome as to determining the change of trend. And ultimately the price worked its way higher here. So the closing high outside of the upper band, a lower high inside the band will often show a top in prices unfolding. So volume, I want to get to some charts in a second. So volume, I'm moving along. Volume is, a lot of people say, should you use volume in your thinking about the price action? The answer is yes and no. I'm not a great volume observer, and I'll show you why. So volume, the characteristics of volumes occur, high volumes occur on a Friday following the monthly options expiry. So if you get yourself an options calendar, an ETO expiry calendar, which equity ETOs expire on a Thursday, and the exercises of stock options is washed through the market on Friday. You often see extremely high volume and you relate it to the price bar and you think there's no correlation. Often there's not. High volumes also occur at potential low points. As early buyers step in, this type of volume is accumulation. High volumes occur following extended moves, which is often referred to as distribution. And this chart of Wesfarmers, this is a daily chart of Wesfarmers in the February-March period this year, where we saw the markets make this significant corrective move. We saw Wesfarmers move down to the $30 mark down here on extreme, and volume was increasing as the stock was being accumulated. And then as the market started to move, that accumulation stopped. And then the stock started to trend along the way. These bars in here, I've marked off the options, a couple of options, interesting options expiry bars in here. This distribution point just here, we see this high distribution here, and we see the same in the market as the market rolled over at that point of time. So when you stand back and consider volume, just consider all of the traders, all the volume, institutional volume, professional traders volume, all of that thing that took place in here needs to be distributed and profits taken on the way. So volume, in my view, takes a little bit of time to unfold. Just recently, this bar here was actually, I think, the down close bar. This one here was an options expiry day, and there was an options expiry day here on the down close bar. Sorry, this was an up close bar and a down close bar here. What we're seeing in Wesfarmers at the moment, we're seeing the price move higher. Again, looking at this recent tops between August, September, and we're seeing volume increase. So I would suggest at this early stage, we're seeing distribution at this point in time as this price moves higher up through here. It's very hard to see this type of volume in high places and consider it to be bullish. Often the markets will wait for some form of retracement to reset their position, if you like. So profits have to be taken to build the books. So I would suggest there's a bit of distribution going on in Wesfarmers at the moment. Now, we're back to the Newcrest Mining chart that we looked at earlier with our averages on there. Newcrest is in a daily downtrend. We discussed this a bit earlier, daily downtrend on Newcrest. What is interesting in Newcrest at the moment is the volumes are increasing down here around this $26 mark. We're seeing this volume increase through here. So there may be a bit of accumulation going on here. If you understand your risk, there's something to be aware of. If you want probability on your side, you would wait for a trend to unfold. Early stages of a trend to unfold. We'd be out here looking in the weekly chart, and we'd be looking for a trending action in the weekly chart. But we want the evidence in the background to say that there's potentially that's what's occurred in the market. So a lot of people would suggest, I've seen people say, oh, well, this is everyone's buying this. Well, they don't actually know that any more than I do, or any more than a broker or insto does. No one knows who's buying what most of the time, but we see their footprints left all over the chart, and that's the bit that we really want to focus on in here. We can see that there's been a 3-bar reversal in the bottom of Newcrest, has led into new highs in here. So this current retracement here is incredibly important that we don't take out the lows and we start to see new highs built fairly quickly. So it's one to watch on this. All right, so we'll take, I think we're just about there. We'll take questions if you want to give that some thought. So now when we start to, with all of this, week 1, week 2, week 3, is outlining some ideas, outlining the way you would observe markets based on some technical strengths in there. So when we start to build a picture, of what we want to do in the markets, the first thing we need to understand is this thing trend. If you go back to week 1, if you don't understand what a primary trend is or a secondary market is. All of the information is in there. And I would say to you, to really get a good understanding of how markets work, or the observation of markets, you really have to understand what a trend is and this concept of higher highs and higher lows in different time frames. Inside MT4, inside Iris, there are zigzag tools in there. They'll mark it out for you. You set them at 10%, and they'll actually mark them out for you. We looked at that in week 1. So understanding when you're building a picture of your application to the market, understand where your trends are. The second week, we looked at this concept around spike highs and spike lows and pivot points and 3-bar reversals and this cup and handle arrangement in here. And then this week, we looked at momentum and volatility. So momentum is based around your relative strength indicator, your MACD and reversion tools, and volume will give you early signs of potential momentum. And then volatility is around Bollinger Bands. So we have some basic concepts together. Basic concepts around trend, patterns, and indicators. We really can build quite a resilient trading system out of that, out of these simple observations of the market. It's quite irritating when I see people with 3 or 4 indicators on their charts and lines and squiggles all over their charts and whatever. It is simply price action will make you the money. If we're aware of price action, we can measure price action through these simple observations of these tools. So next week, we'll start with the building blocks around a trading plan. If you haven't seen week 1 and 2, I really do encourage you to go back and look at them. They're on the FP Markets YouTube site. And next week, we're going to look at ways to that you can find your own edge in the market. Find out what suits you in the market, and it really means that you have to do a little bit of work here. I'll get you started on where to look in that. It's quite simple, but we'll look at where that where we can find where we can start to build this thing called an edge. And everyone talks about this edge. Edge is essentially your trading plan. That's all. But this thing called an edge in there, it will be yours. A lot of people have different amounts of time they can look at the market. That needs to come into your thinking. They like looking at different instruments, whether it's currencies or futures or equities. That needs to come into your thinking. Volatility certainly needs to come into your thinking. Something I didn't mention in this presentation, when you look at the underlying volatility of Bitcoin, for example, against a currency, even some of the bigger stocks like Rio, when you look at the volatility quotient of Rio or a currency and Bitcoin, I've done the numbers on this, and Bitcoin runs between 13 and 15 times more volatile than anything close by. So it's worthwhile keeping that in mind. If you remind me next week, I'll show you what that's about. And I'll mention again, these presentations are on the FP Markets YouTube site. So we'll leave it there. Are there any questions around that? And if you do need some support around this, you can contact support at FP Markets as well. And you can, so I just thought I'd run through a couple of charts here and have a look at, I've got basically 3 indicators on here, and I can put a couple of other things on. We'll take a couple of moves that really unfolded today was Fortescue. The interesting thing about Fortescue, this is a daily chart. Let's bring this in. The first thing we do is we look inside a weekly chart, and we can see that Fortescue is trending up. Back in, let me open this up. So back in here, we have a high, we have a higher low, we have a higher high, we have a higher low. we have a higher high, we have a higher low, a little bit of consolidation, and then this week it has broken out. So clearly Fortescue is in a primary uptrend. No issue with that. So if we bring in, let's take a look at our relative strength. So when we bring in a relative strength indicator into here, we can see straight away that the observation here is that the market has made a new high just in here back on early June. The relative strength moved over 70 at the time. Market retraced and the relative strength moved under 70. Market made a new high and relative strength made a new high. There's nothing to see here. This is really what you want to see unfold. So then we had the market retrace into this consolidation, and I would point out that the relative, this is a weekly chart, the relative strength remained over 70 from early July out to the end of August. So 2 months, the relative strength remained over 70. This concept about overbought in here is probably a misnomer. You'd be looking for other things once it gets over 70 or below 30. You're looking for divergence on there, but the underlying trend is the key here. So we've got Fortescue's made a new high today. What we're seeing is a relative strength hasn't made a new high compared to the previous one. Now, if relative strength moves below 50, which it hasn't here, it would have been reset, if you like, for want of a better word. This would have been something different, but it hasn't moved below 50. It hasn't retraced properly in here, and there's potential is that we may see a lower high come in on the relative strength. Does not mean to say that this can't remain above 70 for 2 months again. No issue with that, but it's just as traders, we need to understand where our risk is on that. So Fortescue on a daily chart. Here now we have relative strength made a high just here at the end of November, and relative strength has made a new high here in line with the price making a new high. Nothing to see here. And of course the daily trend is trending up on here as well. So clearly a bit of news today has pushed that out there. Good question here. What type of indicators should we use in lower timeframes, hourly or minute-based charts to confirm the longer time frame indicators, the same ones? Yeah, you use the same ones and use the same to bring a starting point, if you like, of understanding this. Use the same settings, and once you understand the same settings, then you can step around that and go, okay, well, what happens if I change this or change that? Next week we'll start to look at these smaller timeframes around currencies and that type of thing. But yeah, at the moment, yeah, use the same indicators, same settings, and don't change the values of them. Fortescue to close the gap. Yes, good question, good point. Easiest way to understand what that means is looking at Fortescue over time. Does it change the gaps, close the gaps, I should say? There's a gap left open in Fortescue back here in July. And that was it. I'll also point out something else as well. There's a gap left open in the weekly charts of BHP. Sorry, I take that back. Daily charts of BHP aren't that. They're gappy all over the place because of the way BHP opens in the morning. But BHP on a weekly chart, there's a gap down here at 34, just a few cents in here, and this 34.97 area. This is the only gap in BHP that hasn't been filled in the last 15 or so years. So we're now seeing this gap up here was filled on this high, and we're seeing a new movement underway here. So RSI on BHP is certainly not oversold as yet. Oh, sorry, oversold, take it back, over 70, I mean to say. and there's nothing really to see on there except that it's above 50. Key aspect of this is it's above 50. As it swung above 50, it swung above 50 just in here on this week. Pivot point, there's 3-bar reversal, 1, 2, 3. This bar is inside this one. So 3-bar reversal at the bottom, no pivot point set, and BHP has moved higher this week on a very large range bar. The observation around this here, this large range bar here on the weekly chart, large range bar so far this week on BHP. If you look at the large range bars in the past, they have some follow through, often in the following week, but then of course profit taking comes in. Understand your price action. We can see down here that all of the averages have rolled up. This is a weekly chart. All of the averages have rolled up. 10-period averages have rolled up in here, which is quite a good look on the stock. If we run a Bollinger Band on this, we can see so far this week that the price has moved outside of the Bollinger. This is Bollinger squeeze here. This is where volatility drops down quite low and the bands come in quite close. So this would be the first part of our breakout on the Bollinger Band. We can see in the background that we had a low, closing price low outside of the Bollinger Band, a higher low inside the Bollinger Band, and has set up this movement in here, and then a little close outside here. And we'd often, I think we're a bit advanced now into the top area, but certainly looks to be a volatile, where volatility is changing. One of the John Bollinger's tenets was what he would always base his work around was his common saying was that low volatility leads to high volatility and high volatility leads to low volatility, something that occurred today. Was in BET. Let's go to the daily chart on here. One of the key aspects of, let me just, before we go there, bear with me a moment, just let me go to the index here. Back in February, the index made a significant run down the lower Bollinger Band there. As the index started to turn, and not before, we saw the upper Bollinger Band start to roll. Key aspect of a change in volatility is when the opposite band starts to roll. It's starting to signal that this downside volatility is slowing down. And you'll see that in a lot of observations around price action. The one I wanted to point to today was, I talked about this last week. This was the trade. I took a position down here in BET around, because the trend was starting to break out above these highs. Relative strength was rising. Everything was going for this. It was starting to walk up the band up through here. But we're starting to see the opposite band now swing back towards the price. It's had a very strong move yesterday, not so strong today, a bit of a retracement today, and we're starting to see this band move back. That's enough for me. I'll step out of that and wait to see what happens and look for another entry. We can also see that the relative strength is really nothing to see here. It's made a high, made another high, price has made a high and made another high, nothing to see there. But it has rolled over and is heading back, showing that momentum is slowing down on a daily basis. So I'll leave that there. Next week, bring a pen and a calculator and we'll start to work through some examples about building a trading plan